Oliver, we thought the match was made. There was going to be a $50 billion deal between AbbVie of the United States and Shire of the UK. And now there are some cold feet.
There are some cold feet. AbbVie has put out a statement saying it's thinking of changing its recommendation. It'll have a board meeting next week to decide whether it wants to recommend that investors should reject this deal that they previously recommended. That will be a very expensive move. There's a break fee of $1.6 billion that AbbVie would have to pay to Shire. The reason why AbbVie is getting cold feet is an announcement from the US Treasury a couple of weeks ago about changes to US tax rules. This deal would have been an inversion, where the domicile of the company moves from one jurisdiction to the other.
And specifically to the jurisdiction of the target.
Specifically to the jurisdiction of the target in order to save tax, and there would have been some tax benefits from that. This announcement from the Treasury suggested those benefits might not be forthcoming for AbbVie.
So what were these tax benefits exactly?
So not necessarily the usual ones that you might think of in an inversion. In an inversion, typically you get a highly taxed US company, in this case AbbVie, would buy a much more lowly taxed overseas company, in this case Shire, and move all its earnings onto that lower tax rate. That wouldn't have been the case here. AbbVie already had a very low tax rate. However, AbbVie has a lot of cash, about $9.5 billion at the end of last year. A lot of that is overseas, and the problem comes when AbbVie tries to repatriate that cash back to the US. At the moment, it has a very high tax rate if it does that. In the case of an inversion, it will be able to lower the tax payable on repatriating cash.
And the company generates a lot of cash.
And the company generates
as well,
a lot of
so
future
this
cash.
will be an ongoing problem. It's not just that $10 billion, it's the flow over time.
It's the future cash flow. So that, and the statement made by the Treasury put all of these things in question.
So for investors specifically who are, especially if you were a merger arb and you held Shire, but even those people aside, people investing in a converging industry like this, what are the lessons?
Well, two, I guess. Firstly, be wary of deals that are predicated mainly on tax. AbbVie always said this was also about strategic logic and industrial logic, but the fact that they're thinking of pulling out shows very much that this was a tax-driven deal. And in tax-driven deals, neither company is in control. The government is in control of what it does with its taxes, not the companies. Far better to look for deals where the driver is something such as cost savings, where it's the companies who are in control of that process. The other lesson perhaps is to be wary of deals where there's a very big premium, which is nice for the target. In this case, AbbVie offered a very, very large premium for Shire. That's great for Shire shareholders, but for AbbVie, because they've offered such a big premium, a very small change to the maths suddenly makes the deal logic fall apart, which apparently is what's happening here.
No margin for error then?
No.
Thank you, Oliver.